Hi, and welcome to Random Rogers Big Picture for the week of November 4th. First video in a while, but we're back home, and so back on the saddle. Just one thing on the agenda this week that will kind of morph into something else. I read an article somewhere about this current scare in financial stocks hurting dividend-paying stocks, hurting dividend ETFs, dividend-centric ETFs, and wanted to touch on that a little bit. I'm a huge fan of dividends, been writing about that for ages. Most of the time it makes sense to overweight yield, not exclusively, but certainly most of the time it does make sense. But you don't want to get too carried away, and that's kind of the point. In writing about these things over the months and several years I've been doing this, every once in a while I get a comment about someone wanting to be really heavy in the dividend ETFs, just like they want to be real heavy in the Canadian royalty trusts or emerging markets or REITs or on and on and on. Too much of any good thing becomes not a good thing. You need to be smart, and the reason when you concentrate, generally speaking, dividend-paying stocks are not as risky. Generally speaking, there are certain stocks that pay dividends that are risky, like maybe the shipping stocks. They all have huge yields and are quite volatile. Or concentrating in something that is not supposed to be volatile or risky, having too much of it, at some point they're going to have some sort of issue. None of these companies are, or I should say, it's a high likelihood that none of them are going to go out of business. It doesn't mean they go through a nauseating scare. Some of them might cut their dividends. What's to say that something like a Citigroup, like maybe Merrill Lynch this time around, has to be saved at $5 a share from, whoever. Concentrating too large in any one segment is bad, and this proves the example. Dividend payers, everyone loves dividend payers, yet here, based on what this article is saying, they're getting hit. Kind of an important point, and it also speaks to what I wrote about earlier in the week about, picking sectors, just being underweight financials. If you had just made that one simple decision, you're probably doing a little better than the market through all of this. I tried to make this point, it's very funny, I tried to make this point on the columnist conversation feature on realmoney.com. And I got if you subscribe and you read it, what kind of struck me as a rather peculiar scolding about this from Noah Blackstein. He went on and on, not on and on, that's unfair. He made a point of just saying why he fundamentally disagrees. Stock picking is always the way to go, and of course he had some examples. My reply back was, I'm not going to debate a great stock picker on the matter, but it doesn't make him right. When you start with the sector first, you have the chance, like with financials, and there are other examples, to make the job a little easier. Now, Noah is a good stock picker, but if you look at the history of his fund, and you can do this on Morningstar.ca, you have to go to the Canadian version, and you can get some information. His mutual fund is up a ton this year. As of September 30th, up 22%, 22.12%, so way ahead of me. To be sure, he's having a great year, but if you think about what he owns, Apple at 7.8%, Research in Motion 7.3%, Juniper 5.2%, Intuitive Surgical 5.1%. He's got a lot of four-letter hot potatoes. So when the market's going well, and you're in those names, you're going to blow the market away, and when the market's doing lousy, you're going to struggle. And he's had periods where, his fund has done poorly. His worst year was down 44%, although that was probably during the meltdown. His worst quarter, he was down 20%. In a quarter, again, that was also probably during the meltdown, but if I'm reading this table correctly, he was down 16% in his fund in the second quarter of 2006, down 10.6% in the third quarter of 2004. So when you own those types of names, regardless of anything else, which is kind of what I took his comment to mean, he is bottom up, period. When you do take that approach, that's what you're going to have. Some phenomenal periods and some absolutely nauseating periods. And so that is the complete opposite of what I write about as what I'm trying to do, which is smooth out the ride as best as I can. I would rather be ahead of the market during down a lot, and I'd rather lag the market down during up a lot, if I can't be ahead of the market during up a lot. The beating the market during down a lot and lagging during up a lot, that's not such a bad place to be, as opposed to the other way around. And I can't find anywhere what his risk-adjusted numbers are. As great as his returns are, his risk-adjusted numbers, I would be surprised if they were any good because of the thing that I'm talking about. He owns great companies, and occasionally great companies like this, great growth companies, puke down. So it's kind of an important difference, and I think actually paints a great example. You can take a look at this for yourself on Morningstar.ca. And I guess I don't think there's a symbol for the fund. I was kind of amused. It has nothing to do with the fund. But there appears to be no symbol. I just did a search for Noah Blackstein, which is how I found my way to the Morningstar.ca page. But you kind of need to figure out ahead of time where you want to be. There's nothing wrong with owning a fund like this or names like what he has, but when you overweight them, you're going to have a lot of volatility. And most of the comments that I get on the blog from strangers is they don't want that kind of volatility. I believe most of the clients that I manage money for, no one's asked me for more volatility. And I believe we're assessing their needs correctly based on our ability to retain clients. So it's a good compare and contrast. Hopefully that makes sense. Have a great weekend.